Hey everyone. I'm very excited to share our conversation with Adam Cohen. He worked in investment banking and then transitioned to private equity, and so he has a lot of valuable insights to the finance career. Welcome, Adam.
Could you walk us through like a outline of what your finance career has looked like to this point?
Definitely. So as Josh mentioned, I'm an Ivy grad, like most of you. Graduated in 2018, and started my career in investment banking with Macquarie Capital Group here in Los Angeles. So the Macquarie Group in LA focuses on gaming, but more broadly is a big Australian bank that covers everything from investment banking to sales and trading, asset management, and the like. Macquarie in LA, and particularly the Consumer Gaming and Leisure Group, is what would be called kind of a sell side investment banking practice. So most of the deals that they did was sell side M&A, advising casino operators or casino suppliers, lottery providers, lottery operators, sports betting, and kind of online gaming platforms with strategic and financial advice to basically sell their company, whether that was to another strategic business, to private equity, or to even take it public to the public markets. I spent about 4 years with Macquarie, so working my way from analyst through associate. Kind of interesting times because I joined right before COVID, so in 2018, and kind of saw the whole ride of the industry through COVID into kind of 2021 and 2022 before making the switch to private equity. And so in the summer of 2022, moved across to Sun Capital Partners, which is a middle market private equity firm that is I would say in the Los Angeles office is focused on consumer and business services. So we will typically buy out companies that generally have some sort of consumer touch and feel to it, but it could be more on the services side. So if you think, some of our assets are transportation logistics assets, but they're moving consumer goods, or we have a portfolio of some retail businesses. So, I have a mattress retailer and a women's retail apparel business that's within my portfolio. I'm typically looking for companies that are doing anywhere from, call it 7 to 15 million of EBITDA. And in terms of valuation and equity check, will really depend on the industry and what, the parameters of the business are. But we'll typically write equity checks from anywhere from 30 to $150 million. So a good range, but more on that kind of middle market focus. So to be honest, when I got to Ivy, I didn't know exactly what I was going to do or kind of where I was going to go. I knew throughout high school and throughout my first 2 years at Western that definitely the subjects I tended to lean closer to and enjoyed the most and found the best results and tended to be math courses. So whether that was calculus or pre-calculus, actuarial sciences and the like. It was just more numbers focused. So I knew something to do with numbers post university would be kind of the right way to go. It wasn't really until I got to Ivy until I really learned about call it the main pillars of finance, whether it's from investment banking or asset management or sales and trading, which tend to be the kind of three areas of what I'll call kind of high finance that Ivy pushes its students towards. Of course, there's consulting and there's other roles in finance across working at corporations, and working in kind of other transaction brokerage or M&A type roles. But between all of those, and as I'm sure many of you have saw, kind of the big push is kind of into investment banking and kind of most people, have this, I guess, idea and view of what kind of investment banking is and how it's this great kind of fast-paced environment to kind of go into right after school and how it gives you, good opportunities to really accelerate your career. And the underlying tone is that it also pays well. A lot of people tend to drift to investment banking because of the kind of the compensation that comes with it. But on the flip side of that, you are kind of trading away a lot of your time and you're going to be spending a lot of time kind of working in the industry. And so during my third year, which was the first year of Ivy, went down the investment banking route and wasn't exactly sure where I wanted to be or what I wanted to do, but ended up getting kind of a internship with PI Financial, which I believe they've changed to Ventum Financial, which Josh interned at this past summer. My summer was a little bit more unique because that summer I was also playing in something called the Maccabi Games, and so it's technically you can call it the Jewish Olympics that happens every 4 years in Israel, and so I was going off to play soccer there, and so that kind of limited a lot of the internships that I was, uh, you know, looking for because most internships run through the entirety of summer, and I wanted the flexibility to take some time off to go play. Um, During my time at PI, definitely kind of enjoyed the fast-paced environment and enjoyed the work that I was doing, but part of me wanted something a little bit more. And that's not to say anything against PI, but wanted something, that was working kind of in a call it a bulge bracket or kind of larger size transactions. Um, Came back to Ivy kind of my fourth year and started looking for full-time jobs. And so went through the recruiting process with all the big banks across Toronto, a couple in New York, and just only Macquarie here in LA. And through the process, got the job offer from Macquarie and ended up taking it and kind of making the jump. And I guess the rest is history from there.
What did you do that made you successful with getting the internship at PI, and then how did that transition into a role at Macquarie?
With PI, going through kind of the network of individuals that I knew in Vancouver and getting connected with the right people kind of got me and allowed me in the door to get kind of a first round interview and kind of go from there. Um, and then using PI to kind of as a base platform, I was able to kind of take that story that I developed over the summer in terms of the work that I was doing and then apply it to my full-time recruiting process. So taking, while only a handful of weeks with PI Financial, taking the work that I did and creating a story as to, why I did it and how I did it and using that to really build a platform to really jump from there into kind of the full cycle recruiting. I'll say with full cycle recruiting again, a lot of it comes down to networking in terms of getting in the door and getting that first round interview. I remember my third year summer, despite being from Vancouver, I spent a month in Toronto, just trying to set up as many meetings as I could, coffee chats or any time I could get with individuals who are in Toronto. And so I spent about 3 weeks down on Bay Street just trying to meet individuals for 5, 10 minutes just to talk to them, hear their story, and hopefully give a glimpse of myself such that come full-time recruiting, my name would hopefully be pulled from the resume pile. And so I think that fared pretty well, and I got a handful of full-time interviews. And from there, it's just about kind of knowing, I'd say, partially knowing the technical cold, and there's all the Volt guides and everything, and the breaking into Wall Street guides that are given to most of the students and kind of passed around at Ivy. Of course, it's important to know that, but I also think something else that's important is being able to establish a connection with kind of the interviewee. And so having a connection or being able to really get along with the person is, I think, important, especially in investment banking where you're working long hours and you're going to be sitting side by side with someone. At least for myself, when I was interviewing students to come on to full time, of course the technicals were important and wanted to make sure they understood generally what they were doing. But you can teach anyone technicals, and anyone can learn how to build a model and how to spread comps and how to put together a perfect deck. What you can't teach is desire and the want to work and the hard work and the attitude that comes with it. So being able to kind of portray that if possible, I think helped, me stand out as well. And then also through the networking process, I was able to get connected with a few individuals who are in the Macquarie office in LA. And from there, when they were looking for a full-time candidate, my resume was pulled from the pile, thankfully, and went down the interview process and was able to secure that full-time offer.
How did you go about making these connections in Bay Street? Because I'm sure, like, for example, I've been using LinkedIn a lot, and the success rate of getting through to people is very, very low. Did you find that there was some strategy that works well for you?
Yeah, I would say I probably used about three main techniques. One, sure, LinkedIn was kind of the initial way to get in touch with people. Generally, people who graduated from Ivy were the easiest to reach out to because most of the time they'll take your call. But I never reached out to someone unless I was able to make some sort of connection beforehand. So through the network of people who I met at Western, who I met at Ivy, who I met from summer camp, and who I knew from high school who had gone to Western and gone to Ivy, even a few years older than me, I would use them as kind of a sounding board first. So, for example, if there was someone 2, 3 years older who was from the same high school as me who happened to go to Ivy, generally they would know 1 to 2 people who ended up in investment banking, whether it's in Bay Street or in Wall Street or across San Francisco or in LA. And I would use their names as kind of a reference point. So when I would reach out to someone, I would say, "Oh, I spoke with so and so, and they said that you'd be a good person to reach out to." So I think that increased the likelihood of responses that I got and increase the number of people who did respond to me. And then from there, at the end of kind of all my calls or coffee chats, my last kind of question was, is there anyone else who I can reach out to? I'd love to get a second perspective. Maybe it's someone in a different group, or maybe it's, someone who's more senior or more junior to you, someone who can just give me another perspective and would try build a base of call it 3 to 5 people within each bank or within each group, such that I had kind of a larger area covered and more people who would know my name. So when my resume would go out, if they were viewing it, they could pull it out.
For students that don't have the background and might be struggling, not necessarily like as you said, you can learn and study and do well in the interviews, but they can't even get an interview. Would your advice to like, let's say someone graduating, would it be to get a finance related role, focus on GPA and plus networking? Like, what would be your road of attack? Like, if you hadn't landed PI, how would you have navigated and tried to like work into the industry?
Depending on where you want to end up in finance, it's a little case dependent. I think with the world of investment banking, most of the time, even for summer internships now, and definitely full time. They like to see individuals who have some sort of finance background, whether that's with a brokerage or a boutique M&A shop, or even just working kind of at a bank, and maybe it's not directly in investment banking, but it's some form of finance that kind of allows you to stand out a little bit. And if you aren't able to kind of get that prior experience beforehand. I mean, there was plenty of people who I went to Ivy with, who had no finance experience and were able to get kind of summer internships beforehand. And even when it came to full time, there was a couple, but I think it's a little bit harder to get the full time offer before or if without doing kind of the summer there, and especially with how these programs work, where most banks will look to hire someone for their summer internship and keep them on full time. It definitely makes things hard. I mean, the networking game it's unfortunately the strongest way to kind of get yourself in. And again, it's a tough balance in your story with the MD kind of coming in over the top. But I've seen that firsthand as well, where MDs I used to work with would, pass along interviews to individuals who, in my mind, when I reviewed their resume, I didn't think they were worth it. Um, let alone people who had actually reached out and done the work beforehand, to kind of position themselves well. But a lot of people also reach directly out to our MDs. I think while I never kind of employed that strategy because I always thought, get in with the analysts or the associates first because they're the ones who are bringing the candidates forward. I knew some people who would reach out directly to MDs and try to sit down with them or try, get a hold of them, and they would pass them along to a VP who would then, because of the referral from an MD, look to move them forward.
That's super interesting. And what I'm thinking about more for your story is you did that transition between private equity and investment banking. What do you recommend, first question, to other people to do that transition as well if their end goal is to get into private equity? And secondly, if they do want to go private equity long term, do you think that going investment banking first helps propel their private equity career in the future?
Yeah, so in terms of the world of private equity, historically, and when I say historically, I'm thinking kind of the 2000s. The real route into private equity was through the MBA program, and so going out and getting your MBA. Current times, I don't think the MBA has as much stature as it once did, and I don't think it's the end all be all in order to get into private equity. Myself being an example, but many of the people that I work with as well haven't gone their MBAs. I think investment banking is a great platform to kind of start out with outside of school. It teaches a lot of what I'll call soft skills, which is kind of the determination, the ability to work hard, the attention to detail, kind of all the buzzwords that you hear going through the interview process amongst all of your peers, but really is true. I mean, it definitely helps in terms of developing your hard skills like financial modeling and being able to process through work and put together pitch decks or investment memos, which are different in their own way, but also slightly similar in terms of the work that you're actually doing and putting together PowerPoints in Excel. So investment banking kind of gives you this kind of just baseline that I think when it comes to private equity puts you ahead of other people. That's not to say it's the only route. And I know plenty of people who have gone into private equity who didn't start in banking and they went either, out of college into a corporate role, and from corporate they maybe moved into a transaction advisory role, and from transaction advisory role they moved to private equity. A similar thing with individuals who went to the big four accounting firms and worked in accounting or worked in kind of a Q of E financial diligence type role. And from there, we're able to make the jump into private equity as well. So while banking isn't the end all be all, I think it definitely kind of puts you what I would consider a bit ahead of the game. But I think that there's still plenty of opportunities and options in order to kind of make the jump kind of into private equity too.
So the reason I asked that question then is because if you do plan to do that transition, how early on would you start your networking?
I think there's two ways to look at it. One way, which is the typical on-cycle recruiting, and that is similarly to kind of as Graham or as you said, Josh, how the entire finance world, the timelines has all been pulled forward, and so all the recruiting is highly accelerated. I believe this year people were getting private equity kind of offers before they even started their first day on the desk working in investment banking. When I started in 2018 in banking, we had our summer training across July and August, and we hit the desk end of August, and by I want to say September or October, on-cycle recruiting started. And so now definitely it's accelerated since then. But people had already been speaking to individuals over the summer at, the mega funds being KKR, Blackstone, Apollo, in order to kind of go on and get those full-time kind of interviews 2 years out. Now, that's definitely one way to do it. I didn't go that route as I spent 4 years in banking, which is definitely longer than most. But I had a different idea and different take. I mean, in 2 years, a lot can change and a lot can happen. And before starting investment banking, you really don't know whether investment banking is the right thing for you or whether A, you'll truly enjoy finance in totality or whether you want to kind of consider on in private equity. It's just there's so many unknowns. And going out and signing a full-time private equity offer kind of 2 years out, in my opinion, is just you're kind of signing into the abyss. You just don't know what's out there. For me, I thought it was more important to go the off-cycle route. So a lot of recruiting when it comes to private equity talks about on-cycle and off-cycle. On-cycle being where most of the larger funds go out to all the banks super early, 2 years in advance, and there's this mad craze. similarly to how in university there's kind of this craze to get into banking. But the off-cycle route is kind of when opportunities open up. So they are less predictable and kind of don't come as often, or I should say, don't come as frequently as in on cycle, which comes every 2 years. But they do come, and they do come, across what I'd say a broader range of private equity. So across the middle market, the lower middle market, more unique funds, infrastructure funds, and the like, which will all look for off-cycle candidates. And a lot of that will come through recruiters. So when you're in investment banking, generally, once you start on the desk, a lot of recruiters will start reaching out to you. And these are kind of the individuals who have a general pulse on the market, whether it's with the on cycle or off cycle, but their true client is the private equity firm. So private equity firm will hire a recruiter to go out and find them the top candidates for an opening position. And so spending time kind of speaking with recruiters, whether you kind of just get on the desk or if you're able to beforehand through friends or individuals that who were already at the bank when you summered there, that kind of gets you your initial in with kind of the recruiter. And then from there, usually they will be the ones who will send you an opportunity. And so they'll reach out to you saying, hey, XYZ fund in San Francisco is looking for an associate. Are you interested? And so from there, if you go forward, they'll put your resume in front of the private equity firm, and that private equity firm will then kind of select a few to take on for kind of full-time interviews. Now, it's a little bit different to banking where hundreds of people kind of put their resumes in, and if you have that networking ability, kind of beforehand, your resume can get pulled. With private equity, the first kind of round of defense is the recruiter. So they're taking the 100+ names and they're the ones who are kind of filing it down to 10 to 15 names.
You would get in contact with a recruiter, and the recruiter's almost acting like an agent for you towards these different private equity firms.
So I'd say they're more of an agent on behalf of the private equity firm. So their client and the ultimate person who pays them, if you kind of take that as in terms of kind of who's the decision maker here, is the private equity firm. And so they will hire the recruiter who will go out and go look for individuals. So there's a handful of regional based recruiters here in LA and over in New York as well. And there's more national recruiters that recruit across both cities. But basically, these recruiters will get hired by a private equity firm to go out and find the best talent that they can for the private equity firm. Now, the recruiter will be the one reaching out to all the individuals. Generally, I would say in investment banking, but not always in investment banking, dependent on what type of role the private equity firm is looking for. But if we're thinking the traditional kind of associate within a buyout firm, they'll go to all the analysts across the street at all the investment banks and basically provide them or show them what the opportunity is and ask if they're interested. And if they are, then they will take their information amongst all the other kind of candidates that they pull together and present it to the private equity firm.
What have you enjoyed more, the private equity, investment banking?
The way that I've always kind of thought about just kind of post post undergraduate kind of life in terms of building your career, there's kind of what I would call a pyramid tier of kind of jobs and opportunities. At the bottom, you kind of have the advisors. So that's your typical investment banking, consulting, tax and audit and all other accounting as well. You kind of have the next level being kind of investors. And so those are ones who are putting money to work and kind of, hiring advisors, but also the ones who are helping corporate, which is then the third tier, kind of being your corporate or your entrepreneurs kind of in a similar level. So starting at investment banking, I mean, as an analyst, your roles and responsibilities are to push forward what I would call the grunt work. So, if your managing director brings in a new deal and you're advising a company on a through a sale process, you're the one who is essentially putting together all the materials. So in a typical sale process, your materials will start with a teaser, so 1 to 3 page overview on the company and the investment highlights and what the company does, which typically will get sent out to hundreds of buyers or hundreds or fewer, depending on the type of process you're running. But basically to garner interest. Once that's done and an NDA is in place, the next kind of step of the process is putting forward what's called a confidential information memorandum or a SIM. And so it's basically a book, again, generally a PowerPoint presentation on the totality of the business, where this dives into everything from industry to the operations of the business to the systems that are within the business, the key investment highlights of the business, the finances kind of and the financial overview of business. And as an analyst, and even up to kind of associate, you're the one who's really in control of those. And so you're the one who is putting together the sell side model, which, you'll sit down with management of the company that you're working with and we'll put together the projections and kind of build everything in Excel. And you're the one who truly owns the Excel work product. And from there, you're also the one who owns the PowerPoint work product. And so you're taking all this information, formatting it well and nicely and making it look good, but also kind of organizing everything within the materials and doing all the heavy lifting. So this is kind of where the kind of the ideology that you're kind of trading your time and you're kind of trading your time for compensation type thing that I touched on earlier, where by doing the grunt work and the heavy lifting, generally it takes the most amount of time. So there were plenty of nights where I'd be in the office till 3 4 a.m. And starting at 8 a.m. the next day just because we were on a tight schedule and we had materials that needed to go out. Now, through COVID, there was a bit of a shift where pre-COVID, you'd be in the office to 3 or 4 and back in by 8. But during COVID, your office was your home. And so your hours didn't really matter. And it could be around the clock, kind of almost 24/7-esque because there was no time to go home or to go change or to go do other things. You were kind of just stuck in lockdown. And this was kind of all that you had going on. Um, I think the thing in banking, especially as a junior employee, so when I say junior employee as an analyst or an associate, you are kind of on the beck and call of other individuals. So, you generally will answer to, as an analyst, you'll answer to an associate, who will answer to a VP, who will answer to an MD. And basically, you know, your time is based on their time. And so you have less control over your time because something needs to get done and something needs to get worked on, something needs to get completed. You're the person who has to do that. So there's this significant kind of demand that is asked from you, and it's definitely not a walk in the park, but I think if you can kind of get through that and kind of work through it, then you generally come out on the side what I would consider kind of better and stronger. I mean, think any of the times you've worked on a 48 that's been very pressing and you have a report that's due within 48 hours. And sometimes if you need to, you work a late night. Sometimes if you're efficient enough, you can get out early. Banking is very similar to that, except for instead of 48 hours, it's 365 days that you kind of continue working and kind of going through steps of a sell side process after your sim. Generally, people will put in what's called an indication of interest or an IOI, which basically is a bid based on the materials and the information that they know. And from there, you as the banker will put together a management presentation generally, where these prospective buyers or a select few of them will meet with management and go through a presentation in person before kind of putting in what's known as a letter of intent or an LOI, which is generally kind of an almost best and final offer for the company, whereby if you sign the LOI, generally there's an exclusivity agreement where the buyer will get, 30 or 45 days exclusive with the company to kind of sprint through diligence in order to close and actually make the acquisition. Now, in terms of private equity, your kind of roles are just flipped, right? You're the one on the other side who receives the teaser. You're the one who receives the sim. You're the one who receives the management presentation and so on and so forth. But the difference here is you're not the one who needs to kind of put together, an array of marketing materials. Rather, you're the one who kind of has to sit with the materials and make decisions based on the materials. So as an associate, you're kind of what I would say is the first pass generally through materials when they come in. Usually an investment bank will reach out to a principal or a managing director with kind of, a new opportunity. And once, the NDA is in place and it's processed, you as an associate kind of look through all those materials, generally the sim, and we'll maybe have calls with industry experts, but get as up to speed as you can on materials in the industry before kind of talking with or bringing it to your broader deal team. From there, again, as an associate or even a senior associate in private equity, generally you're still in control of the Excel and the PowerPoint. We kind of talked about how earlier whether banking is kind of the right role to move to private equity. And I think all the skills you develop in Excel and PowerPoint through investment banking serve you well as an associate in private equity because you're just able to process through things quicker. So while most of your time is developing your own investment thesis and kind of looking at risks and mitigants and kind of what you could really do to drive value and create value within a business, you're also as an associate putting together the investment memo and you're putting together the returns analysis and you're putting together a lender model because generally you'll go out and find kind of third party financing to help you with the deal. Once you've come to a decision, you put in the IOI as the buyer and you put in kind of a broad range of where you think this business can trade at or what it would be bought for, and you get selected to the management meeting. This is generally where you'll start spending time kind of digging deeper. And so, whether that's speaking to more industry experts or potentially bringing on advisors or, gaining access to management, going through a data room, you'll learn more about the company and you'll learn more about the business before you put in the final LOI. And generally, most people bring it to an investment committee, which is a group of individuals who tend to lead investing at a private equity firm. Now, if the investment committee is on board with the recommendation to put in an LOI offer, generally you as the associate will be the one to kind of take initial pass at drafting the letter before kind of passing it off to a principal or an MD for additional review before submitting it. If you're selected as the potential buyer, you as an associate are kind of there to help with execution of the deal. You'll hire all advisors. It could be an investment bank, it could be a consulting firm to do a commercial study, it could be, a big four accounting firm to do the financial and tax due diligence, as well as IT and cyber. And basically, with your advisors, you'll go off and you'll spend your exclusivity period of 30 to 45 days to kind of chase down all the diligence that you need in order to be comfortable with underwriting the deal and moving forward. So during this time, you're managing advisors and you're making sure that they get plugged in with the company's management as well as the sell side bankers such that they can get all the information they need to kind of create their own reports on various topics. Simultaneously, you're continuing to refine your returns analysis based on information you're learning from management or other industry experts, as well as building out a lender model. Most of the time, how kind of buyout transactions work is generally a private equity firm will put up the equity capital and look to partner with either a bank or a third party, or I should say a private credit group. They'll provide third party financing to consummate a transaction and kind of put the debt piece. You as an associate, you're building out a model that will go off to this lending partner who they will then use in turn to come up with their own idea about, what they're able to lend and how they're able to do it. Um, as you move forward through diligence, you put together another investment memo generally before signing, which will be a final underwriting that goes through everything that you've learned, that your advisors have learned, whether there's any significant red flags you need to understand or unpack before actually going out and buying a company. Um, you figure out, what financing is available and, how much equity do you actually need to put forward typically from your fund. And so once you have all this within an investment kind of memo, you put it again in front of the IC, who'll make a final decision on whether, you're going forward and signing this deal up. And from there, usually it's the lawyers who will then take over, who have been drafting the purchase agreement in the background, but will make sure everything from closing conditions, to just general diligence is complete before signing off and actually closing. And then usually on the day of closing, you'll have what's like a closing call where you just move wires around and people get paid out in all certain different ways. And from that moment on, you're the owner of the company. Now, the big difference I'd say between investment banking and private equity is this is kind of where investment banking ends. So investment banking starts with pitching for a business or, with a good relationship, they'll get the business. They'll spend time with management building all the marketing materials and help walk them through the sell side process. But once the deal is complete and a private equity firm purchases the business, the investment bank goes away. So that process could take anywhere from a couple of months to a year, just depending on the deal.
How many companies do you think a private equity would hold at one time? What is sort of the percentage you hope to be successful in private equity? I mean, I'm sure it's probably 100%, but like realistically, what are you sure?
Yeah. So so maybe I take that in two parts. Um, the first part, the number of companies you hold, I mean, that will generally depend on the fund size. Us at Sun Capital across three funds that are currently existent. So we're currently investing out of our eighth fund, but we have portfolio companies that sit in fund six, seven, and eight still around, and we have about 33 or 34 portfolio companies worldwide. So Sun itself has all three offices in the US, that's Boca, LA, and New York, and an office in London as well. So across those four offices, we manage 35 companies. Now, there's firms like Blackstone and KKR or Hellman and Friedman or Apollo. They have hundreds of companies that they own. Now they have many different funds and different type of funds, whether it's a special situations fund or a lower middle market fund or a large buyout fund, so on and so forth. So I think it really depends on the fund structure. It depends on the amount of funds that you have. A rule of thumb I was always told while at Ivy taking kind of the private equity course in my fourth year was that generally in terms of the equity you're investing with each company, a rule of thumb is to think about 10%, i.e. with each fund you have about 10 companies in each fund or so, and 10% of the equity that's fundraised goes to each of those portfolio companies.
What success rate are you
Success rate, right? So yeah, as you mentioned, I mean, 100% is kind of the target. Now, private equity writes to a different or underwrites to a different return. So in venture capital, which again you kind of mentioned, is this idea where you invest in hundreds of companies with the goal that, a handful of them 50 times the return and basically makes the entire return for the fund. In private equity, the general rule of thumb is you write to a 2 times return on cash or a 20% IRR, which is, I would say, the kind of general idea. Now, different funds, again, will underwrite to different return thresholds and have different ideas about what that return should be. But I'd say if you're able to anywhere from double or above the value of your investment within a 3 to 5 year period, generally that's viewed as a pretty good investment and that's viewed as a general win. Now, if you were able to 4 or 5x a deal, then that's a great outcome. Um, And generally, private equity a lot of the time will look more so at the multiple on invested capital versus the kind of IRR. We had a again the private equity professor at Ivy. He would always say to us, "You can't eat IRR," which basically means that you can have a 20+% return, but IRR just really all that does is it's the amount of time really to discount to get back to zero or the net present value back down to zero versus the actual multiple on your investment is how much cash you've actually made. So if you put in, a $10 million equity check and you double it, then you're getting back at, 20 million, you've made a $10 million profit right there. So generally, private equity will look to just a cash on cash return or an MOIC. There's plenty of different ways to kind of look at it and kind of cut it. But as a fund, hopefully at most maybe one is a difficult portfolio company, but generally you want all of them to be kind of a success.
Is there any skills that you see that you will either have or don't have that would be really like helpful in a private equity role?
Yeah, I think a couple things. One, if you look at, and I can walk through a few different categories. One being law, it definitely helps understand the legal framework, especially when it comes to negotiating a purchase agreement and understanding um, kind of the various aspects and what goes into a purchase agreement and knowing, how to deal with lawyers. So that's definitely helpful if you have that law background. Coming from a call it financial advisory, just being good with numbers and understanding the accounting and how everything kind of flows within the business is, I think, a plus. I think, individuals who come from industry. So, a handful of times you'll generally see maybe some of the partners used to be a CEO at a company and they sold it to private equity or something. Then they themselves have made the move to private equity and having that industry knowledge that they've acquired over that time. And even as a junior, whether you're working, say in banking or in equity research or in some other form of kind of finance or corporate where you have a specific industry background can generally be helpful depending on the fund you're joining. I mean, if you're doing all your work in healthcare beforehand, you join a healthcare fund, yeah, you'll be able to understand kind of the products and the businesses that you're buying maybe a little bit better than an individual who doesn't have any background. I think there's a few things that, a good private equity investor needs. One, I mean, definitely, again, private equity is a long game. It's, you're buying a company, you're holding it for 3 to 5 years. It's not like investment banking. So at the junior level, it's a different mindset. At the junior level in banking, a lot of the time is kind of, process through the work as quickly and as well as you can and kind of go ahead and get the deal done. Here, as a kind of junior employee in private equity, you kind of need to own or have kind of an owner's mentality, every decision you make, every dollar that gets spent, you're the owner of that business. You're the one who needs to kind of help drive that value. It's not about just kind of processing work. It's more about kind of being on top and understanding and providing your thought. Um, the senior partner in our office once said to us, a good private equity kind of professional is a truth seeker and not an opinion validator. A lot of people, I think, will generally, develop opinions and, when you're going through the diligence process, have an idea about why something's a good idea, and then basically look for all the facts in order to prove that out. I think, being one who looks at the data first and looks at the underlying kind of facts of the business and speaks to management before developing a kind of thesis helps paint a better picture as to, what the kind of the truth really is here and what is really needed in terms of kind of developing out and kind of helping this business and whether something's a good investment or not.
I was talking to someone else in private equity, and they mentioned this thing of you can't like make partner or really progress in the specific private equity firm unless you have that field of experience. So you're like health side, for example, if you're going to go for like a health private equity stream, if you kind of go straight up through private equity and you don't get that experience outside of it, you can never make it super high in the private equity firm?
I would say there's again, each firm probably has their own different way of doing it. I can tell you with Sun Capital Partners, if you look at all the current and previous managing directors or partners or principals, they all started as associates at Sun and they worked their way up. So Sun has a idea of really promoting from within versus, having someone from outside coming in and kind of taking over. So, that's, I would say, unique to Sun. Now, another firm, HIG, which is a big, call it kind of mega fund based out of Miami, but has offices kind of across the US and Europe and Asia. They, from what I've heard, do it slightly different, where, you come in as an associate and you're kind of expected to go off to do your MBA or do a year secondment at a portfolio company.
When you're looking at like buying these companies, you have a lot of other companies also fighting for that company to buy to add to the portfolio. And inevitably, if you're purchasing the company, that means you probably gave the highest offer.
So I wouldn't necessarily say the highest offer. There's a few other things that go into it that I think make a compelling offer. Um, One, there's a rapport with management and with the seller. If the seller's sticking around and continuing to work, or if it's just a management team that is getting sold, kind of, or the business getting sold by another private equity firm, generally management likes to have a rapport with their new partner. So if you have through the diligence process just a terrible relationship with one another, and just because you put in the highest bid, sometimes, I mean, depending on who the seller is, they will select somebody different. Now, that's not always the case and can kind of change one way or another. But another thing that kind of plays into it is speed and certainty. So, private equity firms that are able to offer faster speed to close is something that sellers will generally kind of like and look for. Or if they have certainty, i.e., they have a large fund that sits behind them that, they can go right out the equity check and there's no financing contingency, which basically means there's no need to go get third party capital to lend on the business. And that provides comfort to the seller that a deal can actually get done here. For example, I currently have a business that's under LOI that we're looking to close on the next couple of weeks. We believe our bid for the business was lower than the other party that was involved. But the reason kind of why we won was one, a little bit of rapport with management, but two, which is more important, was we had more speed and certainty to close.
When you get all these offers, you probably get like hundreds of offers. How do you know which ones you want to kind of focus on?
And you're asking in terms of the selling company and kind of the bank who's running that sale process.
I mean, like more from like the private equity firm, like you're probably getting like hundreds of offers
Oh,
from
I see
banks.
what you're saying.
How do you go from so many offers to then pick like, okay, like we want to get like the funding for this one and attack that offer?
So yeah, so that comes into a bit of the grunt work of the associate, right? So you can get, maybe you have one or two new deals in your pipeline, or you have 15 or 20 new deals in your pipeline, and you'll be getting sent tons of materials, and it's kind of you who takes the first pass reading through the materials, developing thoughts of whether something's a good investment to then kind of bring it to the broader group. And the broader group can be the deal team, the investment committee, or others. And so, as you're looking through and reading the materials, there's certain things that in private equity you'll generally look for. One, on the financial side of things, you generally like businesses that are cash flowing, right? They have a good kind of free cash flow yield such that, if you bring on third party debt, they're able to fund that debt, or they're able to provide cash for a dividend or provide cash to go do M&A and other kind of accretive add-ons.
Adam, we don't want to take too much of your time here. Is there any key things that you think we haven't touched on here that like you would want to address?
Yeah, I don't know if there's anything too much. I mean, as you kind of progress through Ivy and through years in investment banking and private equity, or kind of whatever else you do, you generally have a lot of people who will, or maybe not a lot of people, but you have people who will reach out to you and kind of ask for advice and based on your experience. The one thing that I generally, I think, try to tell people or tend to tell people is, especially at Ivy, is just don't get lost in the herd mentality. There's this strong herd mentality that, you got to get the top job right away. You got to be the first person to do this and that. And, the game of life is a long one, and there's ups and downs along the way. And just because someone has, what they think and what everyone thinks is the most desirable job, it could be a great job and it could be a really great opportunity, doesn't mean that, you yourself as an individual can't get there or won't be there.